Hi, everyone. Welcome to another ShareWise webinar. Today, we are lucky enough to be joined by Travis Butcher, who is the Fund Manager over at Charterhall CQE. Thank you so much for joining me today, Travis.
Thanks, Caitlin.
So today, Travis will take us through a presentation. Whilst he is doing that, feel free to pop in any questions down below in the Q&A and we can get through them afterwards. I'll hand it off to you, Travis.
Thanks, Caitlin. I'll just load this deck up. Hope you all can see that. Caitlin, can you see that?
Yep, that's great.
No, perfect. Thank you all for your time and interest in today's webinar, which is about why social infrastructure property is an attractive asset class. I'll start talking about the social infrastructure market and then provide further detail about Charterhall Social Infrastructure Reit, which is the largest listed social infrastructure fund in Australia. Firstly, the question we get asked a lot is, what is social infrastructure? There's no industry definition. I know that the Property Council of Australia is actually working on a definition at the moment, but we look at it as the buildings and spaces that facilitate the delivery of social and community services by governments and other service providers. It plays a critical part in our day-to-day lives and really is a key driver to the way we live. When you drive around the weekend, you'll see considerable assets, whether it's libraries, community facilities. A lot of the assets you see are social infrastructure. This is probably a good way of demonstrating. I often find examples are the best way to sort of define something. As you can see from this list, it's really a broad and diverse list. And it's probably we've put some examples of each of the different subsectors there and what you'd sort of assets you might find. As you can see, it's a very diverse list. And all that, as I sort of mentioned before, that as you go about your day-to-day life, you're either familiar with or you regularly use. But as you can see, they don't fit into the typical real estate asset sort of category, which you can often Australia's between office, retail and industrial. I think you'd probably be surprised there, whilst people, if you had to ask what are social infrastructure assets, hospitals, universities, schools, aged care would often come to mind. Whereas I think you look at some of these ones like community centres, museums, waste transfer stations, all things that are, whilst you don't immediately look at as exciting real estate assets, are critical to sort of our quality of life. So as you can see from these assets, there's a significant universe of investable assets out there, which we don't sort of talk about as normal property investors. This is really interesting around why do you invest in social infrastructure? I think there's sort of the three key points at the top there really drive all this. Firstly, they deliver secure and stable income streams. I'll go into a bit more detail about each of these. Secondly, there's really good opportunity for capital growth. And then what we expect by putting the combination of those two points together, you would get really superior investment performance from a combination of both of those things. So going into a bit more detail around each of those, in terms of the income stream, typically these assets are leased from governments, so whether it's state, federal or local, or you look at other assets that have got significant government backing, for example, childcare, aged care, where that funding is essentially underpinning those operations. I think another critical part of social infrastructure property is the location, and that's critical because ultimately social infrastructure is about sort of supporting the community and being accessible by the community. So you want assets that are strategically located in that you don't want, say, for example, take a particular city, you don't want all the hospitals on one side of the city. They've got to be spread across all the population. So they're strategically located, which is very important. And what does that lead to from a property point of view? You end up with long-term leases. And that's typically, you can get anywhere between 15 to 20 years lease terms. And that's because ultimately and that sort of compares to, say, an office asset, where typically tenants will sign up for no more than 5 years. That's really important from an investment point of view. You get long lease terms. And that also then leads to high tenant retention, because that asset is located for a particular reason, and that tenant wants to remain there. So you get significant tenant retention. The interesting one's using childcare, and where CQE is Australia's largest landlord in childcare, so we're very familiar with the space. But ultimately, childcare operators, the value of their business is intrinsically linked to the lease and that property. So you can't have, and that's why the operators are happy to sign up for long leases, because they can't move. It's different to having a little retail shop on one of the suburban shopping centre strips, where you can jump from one side of the street to the other. Childcare centre operators can't, because there's not that availability of alternate premises. So that really is a good sort of characteristic of social infrastructure assets. And sort of finally on that point, which is one that's these assets are typically triple net, and that means essentially the tenant or the operator is responsible for all outgoings, capital repairs, insurances and taxes. And that's really why you ask, and that's really around basically, as the community are using these assets day in, day out, you want the operators basically being in full operational control of those assets. So if something breaks down, a lift breaks down, or there's some other repair that's needed, the tenant or the operator can fix that as soon as possible and ensure that there's no sort of disruption to their end users. I think in terms of growth in this sector, I'll talk to this in more detail, but you've got significant demographic trends that are helping this, positive trends helping this in terms of, from Australia point of view, Australian population continues to grow. We're also getting, unfortunately, we're getting older as well. So that tends to drive need for more social infrastructure. And then also, I think as a society, we're more demanding. We want better facilities, we want better pools, better libraries. We want that better sort of quality of life as well. So that's a benefit in this sector. I think as well, we sort of talked around the assets that you can invest in social infrastructure. It really gives you that diversity and opportunity for growth that you don't see in some of these sector-specific investments. Then finally, just to bring that all together in terms of the investment performance, we think based on all of that, you get better, superior returns on a risk-adjusted basis. You've got strong tenants, you've got strong growth opportunities, and you also don't have that correlation to the economic cycles. And I think even coming through, one of the things we saw during COVID was that assets that are providing essential services remained open, and their incomes remained resilient through that phase. So it really it provides that different sort of avenue to the sort of typical business cycles, where, say, for example, office in a high, when there's a strong demand for office, rents increase, and you have that, you might benefit if you do all your leasing at that point in time. And then it all depends on where you are through the cycle. So these assets provide good through the cycle investments. This is a survey that was done a few years ago now, but really picks up on a number of factors which I sort of touched on. So I won't go into a great deal of detail on this, but the demographics, the diversification, and the stable income return are some of the points coming through from investors looking to invest in social infrastructure. Who owns these assets? Governments have typically been the owners of these, and that's from anywhere from federal, state, and councils. Local councils own all of these assets. And that's just been the traditional method of providing this to the community through taxes collected from the society. So it's interesting, they do typically like to own the assets. One council we met with a number of years ago said that they're asset hoarders. They like to collect assets, which sometimes doesn't, they're not being optimised in terms of use. You might have a particular asset that a council owns or a government owns that could be more efficiently developed. And you look at currently, as we look at the moment, in terms of what does Australia need, more housing? Is there better ways to utilise assets to provide sort of solutions that will benefit all of us in terms of society? We think that some of the budget deficits that have been at state level and councils are doing it tough in terms of having their rate caps on at the moment. We think there'll be better opportunities to then, based on that, the private capital to get involved. I think a lot of the governments don't typically like to sell assets. So we think probably in terms of opportunities in social infrastructure, they're probably more likely to come from developments. So this photo on this page is over in Adelaide. This is a brand new, recently developed emergency command centre, coming off the back of the bushfires that happened in the last few years. So all the emergency services, if there was an emergency in Adelaide, this is where all the response to that emergency is coordinated, brand new purpose-built building. In terms of the market, what's the size of the market? Once again, as it's not a traditional real estate market, it's actually quite hard to put a size on it. And given that sort of ownership, which I touched on in terms of the government, all the government sectors owning it, it's very highly fragmented, and people don't typically count how many and value how many ambulance stations we have or transfer waste stations we have. So it is that fragmented nature. Research coverage, none of the major real estate houses cover social infrastructure. They're starting to increase now in terms of health and childcare, where there's probably more transactions, and that's worth them doing research on. But just to give you a scale of and it's pretty broad brush number, but the Infrastructure Partnerships Australia put out a number of $700 billion of funding. So that's like, you put that over 10 years, that's $70 billion a year of funding. That's infrastructure, so it is a bit broader than social infrastructure, but just to give you a scale of what we need, it's pretty significant. Moving to the key thematics, as we touched on, I think in terms of this is one of the reasons why there's such strong growth in social infrastructure. You've got three sort of thematics I want to touch on today. Firstly is demographics. I think you've got our population's growing, getting older, so that has impacts on the social infrastructure assets we need to service that. These are traditionally funded by government, either directly or indirectly, so I'll just touch on that. And then you've got the big thematic at the moment around environmental, social and governance, ESG, and energy transition, and so I'll just talk about what that impact on that is as well. So in terms of demographics, I think the big one is around population growth. CBRE put out some recent research which shows they've estimated there's going to be an additional 3.7 million people in Australia by 2031, which is an increase of 14%, which is a considerable increase. And that's sort of an average of 460,000 additional people in Australia every year, which is a considerable increase, and that's the leading growth in the OECD countries as well. So what does that mean? That means it needs to be, you think about that sort of close to 500,000 people year in, year out. It significantly adds to the need for schools, hospitals, etc., and other facilities, just to maintain our sort of standard of living. And the majority of that's coming through from migration, and that's been, I think, the 2 years of COVID where Australia really cut down on immigration was cut back, and people weren't coming to Australia because of the lockdowns and the restrictions. CBRE has estimated that's close to a million people coming into Australia over the next 3 years. In terms of aging and population, got some stats there that basically forecast that 1 in 5 of us by 2066 will be over the age of 65, and the sort of median age is jumping up by sort of 3 to 4 years. So what does that all mean? More hospitals, more aged care facilities, more retirement living facilities are needed to look after us as we all get older. This is talking about government expenditure. As you can see here, it's all, when you look at the numbers in total, it's sort of over $200 billion of spending on essential services. You look at health alone's over $116 billion, and that's going to continue to grow both on increased population, and older population. Childcare, that's got the biggest growth, up by 41% to 15 bill. The government recently introduced, came effective in July, the increased subsidies to parents, which is a great thing for the sector, allowing more people to send their children to childcare, which will be a positive for the industry. It essentially enables people to go to work, both parents to be able to work while their child's looked after. And secondly, it really drives home that's when the children in that age are really learning a significant amount, and that's 0 to 5. So that's important to get Australia, the education standards up in Australia as well. Education and transport and communication just really driven by Australia trying to get smarter as a country, and also just growing in population and driving those increases. But coming back to my point earlier, at points in time, governments can't afford to keep on spending this money. And if they've got assets that are tired, need capital invested in them, I think there's a great opportunity to partnering up with private capital to build these services. Because ultimately, as residents, people don't know or aren't interested in who owns those assets. People want to be, if a new police station is built in a particular location, the residents are happy because if they feel safer, they're not going to ask who owns this asset, whether it's owned by private industry or whether it's owned by the government, and what the lease terms are. They just want to feel safe. Talk ESG. This is really important now in terms of it's really now moving from a must-have rather than nice to have. We're fortunate with social infrastructure that we do a lot of, from a S point of view, social point of view, we're providing a lot of benefit to the community by these buildings that we've either bought or developed that are providing that social impact. Like, for example, across our 350 childcare centres we own, they're typically 100 children go to those each day. So you think about the maths of that, if 35,000 children that are attending our properties day in, day out, learning, which is a really important thing. So we're working on further across our portfolio, energy, solar, those things, but it's sort of a key part of and why social infrastructure, because a number of investors and capital looking to for social impact focus as well. Moving to, conscious of time, CQE. So I'm the fund manager of CQE, which is the largest listed social infrastructure Reit. It's been listed since 2004 in the ASX 200. In terms of portfolio, it's got over 350 childcare centres, and another further 5 in development. It's also got 8 childcare long WALE social infrastructure assets as well. In terms of the properties, it's got a long WALE, which is the weighted average lease expiry, which is 13.6 years, and 45 tenants, and we're 100% occupied across the portfolio in terms of tenants. In terms of our strategy, we're traditionally 100% childcare. We've now looked to expand beyond childcare into the broader social infrastructure space, and now introducing a number of larger scale assets. That one I showed you before, the Emergency Command Centre, and that's getting stronger covenants from governments and divesting of smaller sort of non-metropolitan childcare centres. Key for us is getting those assets that are underpinned by government support, because that essentially underrides the rent that can be payable by the operator. For us, and then the key sort of attributes we want, we've been looking for our investments, we want modern assets. You want assets that are strategically located with that high underlying land value that ultimately drives, one, by having strategic locations, get long lease terms, but the high underlying land value provides that alternate value driver. If in, say for example, a childcare centre, if in 20 years or 30 years, the operator, for whatever reason, doesn't want to be there anymore, you've got 1,500 metres to 2,000 square metres of residentially zoned land that you can develop for whether it's townhouses or whatever else in terms of medium density housing. And then we've talked about the triple net lease structures. That's a sort of key focus for us as well, to minimise leakage in the fund. What's this all meant in terms of our investment returns? You can see there over a 10-year period, annual distributions have grown by 5.1%. NTA, or sort of value per unit, it's up 12.6%. And you can see there we've been superior to the sort of our benchmark index, the ASX 200 A-REIT index, over all those sort of time periods between 1 and 10 years. Talked about a little bit of this already, key portfolio metrics. I think we've really focused on having sort of metropolitan locations, and that's largely to drive, one, typically metropolitan locations in terms of value are higher. Population growth is typically happening in the metropolitan locations. So that's where we're really focused on, which will drive ultimately land value appreciation over time. And we have focused on Eastern Seaboard, similar, 82%. 96.9 hectares of land. This comes back to the point I was making before around the underlying land value and then alternate sort of value driver. Our lease structure, typically we have every year there's a rent escalator. We've got 78% of our leases are on fixed reviews, which are average 3%, and 22% are linked to CPI, obviously, which is above that 3% at the moment. So when we forecast the numbers back at December, the forecast rent reviews moving forward 4%. The graph on the right there, you can see our tenants. That's a mixture of childcare tenants. We've worked on our diversification of our tenants. Good Start, who are Australia's largest leading childcare operator, they've reduced down from, they're above 50% now, they're at 35%. And you can see there we've added additional government bodies as part of that, just to really improve that overall tenant mix and quality of your income coming into the portfolio. These are just some of the examples. I won't go into a great deal of detail on these of our sort of long WALE social infrastructure assets. You can see they're all modern, newly developed, purpose-built assets, all ranging from education and health up in Robina, emergency services in Keswick in Adelaide, through to transport in Eagle Farm in Brisbane, all core social infrastructure, providing services that if for whatever reason these assets weren't operational, would have an impact on society, whether students can't go to TAFE, whether people can't catch a bus to work in Brisbane, all sort of key social infrastructure assets, all with long lease expiries, annual escalators, and government tenants. ESG, key, I've talked about in terms of solar. We're looking at other avenues to improve our performance by partnering up with the Green Building Council of Australia to do a rating tool for our assets. I don't gather the other really important one, which we're doing from a social point of view, is partnering up with Good Start, who's our number one tenant customer. We've actually provided them some funding to help families and children that are less fortunate, that are unable to attend daycare through to their circumstances. We've allowed 55 families over a 2-year period to access fee-free childcare as well, which we're very proud about. So that's a pretty quick wrap. I was conscious I wanted to get through it pretty quickly for you all, and but happy to take any questions.
Thank you so much, Travis, for such a good presentation. That was a really good overview of the fund. For anyone that joined in late, please put in any questions down below in the Q&A box and we'll get through them. Oh, we have one submitted here. What are the risks to earnings Travis sees in the next 3 years and how will they be addressed?
I think from a CQE, I'll talk about the property, from a property perspective. By having long leases, we're very well protected, and also by having triple net leases, that essentially if there's any increase in property expenses, such as look at insurance expenses are increasing at substantial rates at the moment, those sort of things are all borne by the tenant. So I think we're pretty well covered. One of the key aspects we look at, if there is shorter leases, we typically know the tenant's required to give us anywhere between 3 to 5 years notice as to what they're doing at the end of that lease period. So that gives us time. For example, if someone with 3 years left on their lease says, I don't want to be there anymore, we've got 3 years to, whilst we're getting another 3 years of income, we've got time to find an alternate for that property. So from a property earnings point of view, we're well protected. I think from a fund earnings point of view, the biggest challenge we've had in the last 12 to 18 months has been around interest rates. So we've hedged, obviously not being 100% hedged. That's had some impact on the fund earnings, and that obviously moving forward, depending on where rates get to, that will have some impact moving forward. So that's probably from a fund earnings point of view, that's really the biggest risk. But we've put hedging in place to protect as much as that as we sort of think is reasonable.
And a question for me, you mentioned in your presentation that essential services such as your social infrastructure assets doesn't correlate with the economic cycle. But do you actually find that when there is an economic downturn, there's actually a greater demand for this social infrastructure from tenants and actually a more willingness from government for private capital investment?
That's a good question. Like you'd asked a lot around what does, with given our focus on childcare as well, what happens if unemployment was at 10%? What happens to childcare usage? I think obviously if the household budget gets stretched to a point where due to unemployment, they can't afford to pay to go to childcare, well, there's got to be some impact. But I think the important thing now is with government funding, and for low income families, government funding's now at 90%, the government's paying contributing 90% of the daily fee. So if people are looking for jobs, I think they'd still prefer their children to be in daycare. Like you look at the average daily fee sits around $120 a day. So the $10 to $12 a day, people would probably prefer to send their children, keep that routine, keep their learning whilst they look for jobs. But I think you're right though, in terms of like we had, for example, because given it's such a broad mandate as well, social infrastructure, like we had social housing. It was one of the things in the accommodation section. Like obviously, as if there's deterioration in economic conditions, the need for greater social housing is going to increase. So I think we looked at that and went, childcare doesn't, or whether it's health, people are unfortunately going to get sick year in, year out. People need childcare, people need to go to school, people need to catch public transport year in, year out. You've got that real, you don't ride the cycles of economic demand, and I think that provides that stability to the sector.
And as a lot of the infrastructure of the fund is dependent on government leasing or is government owned, what is the scope of your relationship with the government?
It's always one of the challenges dealing with governments. So we'd love to do more with governments, and I think if governments, and coming back to the point I made earlier, residents in a particular location aren't concerned about whether it's a police station's owned by a government or a private enterprise. Traditionally, governments have liked to own all their assets. So it's one of the barriers we're trying to break down with governments is, and for example, you look at, I'm in Melbourne at the moment, where with our state government had to cancel the Commonwealth Games, obviously starting to need more funds to fund the social infrastructure. When you look at those numbers and going, well, there's 500,000 population growth every year. Well, that's probably going to be 100,000, 150,000 in Victoria every year. That means assets are going to need to be built, schools, hospitals. And when the government's in a position it's at the moment, it's going to need to seek private capital, I think, to assist with those objectives that society is going to demand. Yeah.
And what sectors do you think there's going to be growing opportunities for private capital to invest in social infrastructure?
I think the easier ones at the moment are like obviously childcare and healthcare have got sort of that established market because that funding is coming indirectly from government. We think universities are another sector that will be some good opportunities, because ultimately we're competing now on a global stage for overseas students. And so if you need to compete, you need to offer to, when someone's in Hong Kong or Singapore and they're weighing up whether they go to London, go to America, Canada, Australia, you really need nice, shiny, modern buildings and with research facilities, and to really make that decision to come to Australian universities, that costs money. And during COVID, the universities were doing it tough. So I think there's some good opportunities there. I think still the councils, you look at around what all the assets local councils own. When I drive around on my weekend, driving my 3 children from all their sporting events, you look at all the assets you could look at and go, well, there's great opportunities there. So I think partnering up with local councils or state governments, there's great opportunities. It's just a challenge often with these governments, there's continual movement of personnel. So when you build relationships, sometimes can change. But we think we're well placed at sort of Charter Hall Group, given the size of Charter Hall. We think there's opportunities to try and unlock some opportunities across those sectors.
And final question from me. You talked about strategic locations with high underlying land values. And I know you mentioned that they're primarily located across the eastern seaboard, but how dispersed across Australia are the assets? Are they primarily concentrated in certain states?
Yeah, so we've got like Melbourne, Sydney, Brisbane. That's like a lot of our assets. We're happy to do, like we've got assets in Adelaide and Perth as well. It largely comes down to, we often get asked, what's your ideal sort of investment? Ultimately, it's you want a strong tenant. So ideally, you want the best tenants you can get are probably your government, federal, state tenants, and that strategic location. So if it's in a good spot in a major city, where the property lease terms and acquisition terms meet our hurdles, well, then we're happy to invest.
And I'm in Sydney, the cost of living has dramatically increased in the past few years. Have you seen a very exponential growth, like in New South Wales, for social infrastructure?
Well, I think, there's continued need for it. So I think across the board, I think that, I know it was a broad number, but that $700 billion that we need across Australia, I think it's just, and that's probably when you look at that, that was done a number of years ago. The cost of actually doing that now has probably just grown just due to cost escalations, as opposed to ignoring the fact that the population's grown since then as well. So yeah, that's one of the challenges is when developments is that cost escalation. So it is challenging to do developments. And we've stopped doing, we're not building new childcare centres now just because of the smaller asset size and the development risks that are attached to that with builders, planning approvals, etc. So, but we're still keen to do larger scale developments with sort of that end user being government or government sort of backed income or tenant behind it.
Okay, well, thank you so much, Travis, for joining me today. Thanks everyone for watching. If you have any questions for Travis afterwards, you're welcome to email me and I can pass them off to Travis. So this recording will also be posted onto YouTube if you'd like to revisit it. But yeah, thank you so much, Travis, for the presentation and for all the great questions, everyone.
No, thanks, Caitlin. Thanks, everyone.